ETFs have been something that a lot of people have been sounding off on. All this money pouring into these funds has shifted things. What's your view?
The chapter in my book on ETFs is called A Traitor to the Cause. Traitor, not traitor. Wouldn't dare say that, but it is that too. I'm bothered about ETFs. Think about it this way, that we have passive investment strategies. And there are two groups that own them, passive investors and active investors. And the traditional index funds, TIFs I call them, and ETFs are clearly passive funds owned by active investors. And I looked at the growth of exchange-traded funds and traditional index funds in the last decade, roughly, and they were virtually identical. They'd both grown at about 18% a year. And then I looked at the sources of that growth. And the sources of that growth for the traditional index funds, it was 65% appreciation and 35% new capital coming in. And for ETFs, it was exactly the opposite. 35% appreciation and 65% for capital coming in. Well, wait a minute, there's a message here. If the appreciation is heavily concentrated with traditional index fund, what does that mean about the returns of the two? We go over the data, and it turns out that the traditional index funds have had a return during that in that period of 7%, 7.1%, and the ETFs have had a return, the average ETF, of 4.7%. That means you had your choice between a 10-year return of roughly 120%, I'm doing a little bit of this off the top of my head, or about 70%, 110%, 120% from the traditional index funds, and a return of about half that, 65%, from exchange-traded funds. Why doesn't anybody know that? Does nobody care? And the reality is that ETFs are probably the greatest financial innovation of the 21st century. They are probably also the worst investment innovation of the 20th century because people use ETFs badly, and the sponsorship is wild. Henrikaufman would call them, if he were around at this meeting today, he would call them financial buccaneers. Open up a paper 2 or 3 days ago, we have two new ETFs. One is ETFs that are long electronic marketing firms and short retail marketing firms. That's an ETF. They brought it out just to capitalize on this momentary trend that's going on there. Then we have one just brought out for distillers, people that like to drink or whatever. And then we have another brought out for people that believe GOP policies will win. And of course, another one that people believe that Democratic policies,
like
you have your choice.
Risky bet.
It's an insane marketing game in which, do I make myself clear?
Yeah, I think you do. I think you do.
In which salesmen need something to sell. So we throw out more new red meat to be sold. It should be much less of a marketing business and much more of a fiduciary business, I think. I know. And it's obvious that trading is your enemy and is the investor's enemy and the broker's friend. I mean, this is not complicated. You see this in ETFs. The capital flows are wild, up and down, month after month. So you look at a given month and you see let's say a $10 million inflow into ETFs, and it's $9 million in the spider. It's a very market-moving thing that they're very proud of at State Street, and they brag in the paper every day. It's the first time in history that any stock has turned over at 15 million shares an hour. They're proud of that. They're proud of that. Think of that. What is that to be proud of?